Wall Street just hit all-time highs, but beneath the surface, inflation is creeping back. Bond yields are flashing red, and global risks are multiplying. Europe's walking a tightrope. China's growth looks solid, or does it? And Japan's facing an election that could shake its fiscal future. This is not just another week. If you're an investor, or just trying to keep up, this week's macro signals could change the whole game. Don't miss it. Hit play now. Listen to the full episode and get ahead before the headlines hit.
This past week, we saw global markets charge into mid-July with a surprising amount of confidence, actually. Robust corporate earnings propelled Wall Street to fresh all-time highs, sparking quite a bit of optimism. But beneath those headlines, well, we've caught a subtle whiff of returning inflationary heat in the U.S. Bond yields are testing some long-held psychological barriers, and central banks globally are, bracing for a delicate balancing act. Elsewhere, Europe and the UK delivered a mixed bag of data. Japan tiptoed toward political uncertainty, and China's Q2 growth managed to surprise. But doubts linger about the second half. Okay, let's unpack all of this region by region.
Let's start right here in the U.S., where Wall Street has certainly been climbing new peaks. We saw the Nasdaq soar by 1.5% and the S&P 500 by 0.6%. Setting record highs. Impressive. The Dow Jones saw a slight dip as 0.1%, while the Russell 2000 gained 0.2%, and the S&P Midcap 400 remained pretty much flat. So what's truly driving this?
Yeah, what's truly insightful here is the sheer power of earnings. It's quite remarkable. We saw major players, financial giants like JPMorgan Chase, Citigroup, consumer names like PepsiCo, tech like Netflix, all comfortably beating expectations. Investment banking revenue in particular really surged, and early financial sector earnings are actually pointing to a robust 8.6% year-over-year growth. That's outpacing the broader S&P 500.
Outpacing the S&P, wow.
Exactly. It suggests corporations are adapting, maybe even thriving in this kind of high-rate environment we're in.
That's certainly good news for corporate America, but amidst that, we have a returning guest making an entrance. Inflation. What are the latest numbers telling us?
Indeed. The CPI rose 2.7% year over year in June. That's up from 2.4% before. It marks the biggest monthly increase since January. And crucially, core CPI.
Right, the one stripping out food and energy.
That hit 2.9%. And that uptick was largely driven by, tariffs, as you might expect, and a notable jump in household and recreational goods prices.
Okay. And retail sales also made a comeback, up 0.6% in June after May's pretty sharp 0.9% slide. Though, we should probably note that inflation likely played a role in that nominal increase, right?
Oh, definitely. That nominal figure gets a boost from higher prices.
So what about the bond market? Were fixed income investors reacting?
They absolutely reacted. Bond yields edged higher. The 30-year Treasury yield actually touched 5.07% midweek.
5.07.
Before settling back slightly at 5.00%. Now, that's its highest sustained level since 2007.
2007. That's a significant psychological barrier.
It really is. It shows investors are demanding higher compensation for holding longer-term debt, reflecting those concerns about persistent inflation and, what the Fed might do next.
So the market's eyes remain firmly fixed on the Fed. Futures markets are still pricing in 2 rate cuts by year-end.
Still pricing them in, yes.
But not before the Fed's September meeting, it seems. And there was even some political noise briefly. Stocks wobbled on rumors President Trump might fire Fed Chair Powell, though those were denied later.
Right, that added a bit of drama. This combination of factors, it presents a real challenge for the Fed. How will they navigate strong earnings and rising inflation without upsetting the apple cart, without triggering a downturn? One key insight, perhaps, is they might lean into a higher for longer message. Gently push back on those aggressive rate cut expectations. They could use the strong earnings as a shield, say, look, the economy can handle it. But the political drama adds an extra layer of volatility. It's tricky.
Absolutely. Okay, so as the U.S. grappled with its inflation dilemma, what kind of signals were coming out of Europe this past week? Was it a similar story? The SOTX 600, DAX, CAC 40 were pretty flat, but Italy's FTSE MIB gained, 0.58%?
Europe's narrative was definitely mixed, but there were some encouraging signs, particularly industrial revival. May production jumped 1.7% month over month. Strong energy and capital goods output really drove that.
Okay, so the hard data finally showing some life.
Exactly, after a period of sort of stagnation.
And trade strength. Is the Eurozone holding its own globally?
It seems so. The Eurozone's trade surplus hit $16.2 billion in May. Rising exports and falling imports signal resilience, even with those tariff headwinds we keep talking about.
Right.
And Germany, the continent's engine, is looking particularly brighter. Their ZEW Investor Sentiment Index.
There's a forward-looking one.
Yeah, that hit 52.7. That's its highest since early 2022, fueled significantly by hopes for maybe an EU-US trade detente. Less friction there.
Okay, so Europe's hard data showing signs of life.
Yeah.
But the ECB meeting is this week. Rate policy uncertainty must be looming large.
Oh, absolutely. All eyes on the ECB now.
Right. Crossing the channel to the UK, the FTSE 100 gained 0.57%, helped by a weaker pound. But beneath that surface number, what's really happening in the British economy?
Ah, the UK. Here's where it gets really interesting, maybe a bit worrying. We saw hot CPI data.
Like the US.
Yes, but perhaps even more stubborn. Headline inflation rose to 3.6% in June, up from 3.4%, and crucially, services inflation.
The sticky parts.
Stubbornly held at 4.7%. It defied forecasts for easing. That indicates pretty broad-based price pressures.
Wow. And the labor market? Is it keeping pace?
Unfortunately, no. It's cooling significantly. Unemployment ticked up to 4.7%, which is actually a 4-year high.
A 4-year high.
Yeah. And payroll employees fell again, though wage growth remains sticky at 5.0%.
So wages still rising, but fewer people getting those wages.
Essentially, yes. The key takeaway is the labor market itself is softening, which could impact consumer spending down the line.
This puts the Bank of England in a seriously tight spot, doesn't it?
Absolutely.
Battling stubborn inflation, softening employment. Growth is slowing, but rate relief is tricky. Classic stagflationary signals.
It really has that feel, yes. A very difficult position for them.
Okay, let's shift over to Japan. Markets there edged up cautiously. Nikkei 225 gained 0.63%, TTOPX up 0.40%, all ahead of a pretty pivotal upper house election. What's the mood?
The election uncertainty is absolutely key there right now. Prime Minister Ishiba's coalition risks losing its majority in the July 20 vote.
This weekend.
Right. And that raises significant questions about the future fiscal direction of the country. You know, policy paralysis is a real risk. If they lose that majority, investors get nervous.
Makes sense. And on the inflation front for Japan, are they finally breaking free from deflation?
Well, core CPI did cool slightly to 3.3% year over year in June, below estimates, but
Up about
big but. It was largely due to temporary energy subsidies. Take those away and the picture might look different. Plus, trade pressures are really intensifying. Shipments to the U.S. and China fell, and that new 25% U.S. tariff on Japanese imports starting August 1st adds pretty significant headwinds.
So external pressure could easily offset any domestic inflation push.
That's the concern. Political risk and trade friction are the big watch points for Japan now. Clarity needed on fiscal steps and how they navigate this.
Got it. Finally, let's turn to China, which actually saw a bit of a reprieve this week. Markets were up. CSI 300 gained 1.09%, Shanghai Composite 0.69%, and the Hang Seng quite significantly 2.84%.
Yes, a bit of positive sentiment there. China's Q2 GDP actually beat expectations, coming in at 5.2% year over year.
Better than expected.
Better than forecast, yes, but still slower than Q1's 5.4%. It highlights that familiar pattern. Growth looks okay on the surface, but maybe driven by less sustainable factors.
And the persistent property weakness continues to be the major concern, doesn't it? Is that still casting a long shadow?
Oh, absolutely. The property sector remains the Achilles heel, no question. New home prices fell for a 4th straight month. Residential sales dropped a significant 12.6% year over year in June. That's the steepest decline this year in 2025.
Steepest decline, wow.
And adding to that, factory deflation signals are clear. The Producer Price Index, PPI, slumped for the 33rd straight month.
33 months of falling producer prices.
Yes, it underscores systemic pricing weakness and just low demand for industrial goods.
But what does this all mean for Beijing's policy approach? That Q2 GDP beat might delay immediate, aggressive stimulus.
It could. A short-term growth pop might give them pause. However, the deep-seated real estate pain and persistent price deflation, those continue to threaten the second-half momentum. And frankly, these have potential ripple effects across global markets. It's another delicate balancing act.
Seems to be the theme of the week. Okay, now looking ahead to the macro calendar for July 21st to 25th, 2025, what should you, our listener, be paying closest attention to? In the United States, Tuesday, July 22nd, we have Fed Chair Powell speaking, always a market mover, so listen closely for any subtle shifts in tone. Wednesday, July 23rd brings existing home sales data for June. Housing resilience check. Thursday, July 24th, we'll see the weekly jobless claims, critical labor market indicator. And Friday, July 25th, durable goods orders for June gives us a sense of manufacturing activity, business investment. For Europe, Thursday, July 24th is a huge day. Colossal, even. We'll get the ECB rate decision, the deposit facility rate, the marginal lending rate, followed by that crucial ECB press conference. The market will hang on every word. Also Thursday, Germany releases GfK consumer confidence for August and HGOB manufacturing PMI for July. The UK provides S&P global PMIs for July too, snapshots across the board. Then Friday, July 25th, keep an eye on UK retail sales for June and Germany's IFO business climate for July. Key sentiment readings.
Yeah, the market narrative next week really hinges on these central bank decisions and those key macro prints. The ECB decision and Powell's remarks will undoubtedly shape global rate expectations, potentially setting the tone for the rest of the quarter. Meanwhile, that durable goods data from the US, the European PMIs, they'll offer vital insight into global demand resilience. Are the engines revving up or slowing down? Crucial data points.
Absolutely critical. So pulling this all together, what does this mean for you, the investor, looking at the road ahead? What are the top 5 critical risks emerging from this week's action?
Right. The broader takeaway here is that despite some bullish headlines, especially out of the U.S., several key uncertainties persist that could genuinely shift market momentum. So here are 5 critical risks to keep squarely on your radar. 1. U.S. inflation and Fed credibility. Can the Fed actually tame inflation without stifling that strong corporate earnings growth? Their credibility is really on the line, especially with that political noise around Powell potentially bubbling up again. It's a delicate act.
Very delicate. Number 2.
2. ECB policy tone. Europe's showing some nascent signs of recovery. Will the ECB be dovish enough to support that momentum without reigniting inflation? A misstep either way could derail a fragile rebound.
Okay. 3rd.
3. UK stagflation signals. The UK is showing those classic signs: stubborn inflation, cooling labor market. How will the Bank of England navigate this? There's a real risk of prolonged low growth alongside persistent price hikes.
Huh?
Very challenging.
Definitely sounds it. Number 4.
4. Japan election fallout. That upper house election this weekend, July 20th, it's more than just politics. It could significantly alter Japan's fiscal direction and market stability. A loss of majority could mean policy uncertainty, impacting stimulus, bonds, everything.
A big unknown there. And finally, number 5.
5. China property and deflation pressures. Despite that brief Q2 GDP beat, the ongoing real estate pain and persistent factory deflation are deep structural issues. They could severely threaten China's second-half momentum and, given China's footprint, potentially spill over globally. It's not just a domestic issue.
Definitely not. What an incredible deep dive into the global markets this week. We've uncovered the highs of Wall Street, that subtle creep of inflation, the nuanced signals from Europe, and the tightropes being walked in the UK, Japan, and China. You hopefully now have a clear, concise understanding of the key events that shaped the past week and what's coming next.
Yeah, and the key challenge now, maybe something for you to think about, is this. Considering these different trajectories and unique challenges across the major economies, which region do you think holds the most potential for a genuine surprise, positive or negative, that could truly shift the global market narrative in the coming months?
That's a fascinating thought to mull over, isn't it? Where could that surprise come from? We hope this deep dive has given you that valuable shortcut to being well-informed, providing you with those surprising facts and crucial insights without the information overload. Thank you for joining us on The Deep Dive. We'll be back next week to unpack the next layer of complexity in our ever-evolving world. Until then, stay curious.
Still watching? Then you're one of us, someone who actually wants to understand the markets. If this helped you think sharper, tap like, share the insight, and hit subscribe. Smarter markets need smarter minds. Let's grow this together. New AI-powered episodes drop every week. Imagine this format: AI-powered, sharp, fast, built around your industry, your firm, your market. For investors, leaders, or teams that move fast, we create custom podcasts designed to inform and impress. Curious? Contact us to build yours. Bespoke, bold, built by Flamingo's Research and Advisory.